Hi, everybody, and welcome to our first video on Chapter 11, Corporate Reporting and Analysis. And here, we're going to look at how corporations are structured a little bit and some information on their stock and dividends and those kinds of things. And then we'll take a look at some analytical techniques, earnings per share, price earnings ratio, and dividend yield. And then we'll also look at how we issue corporate stock. And probably the most difficult part of the chapter will be on stock dividends and stock splits. So we'll take a look at that as well as treasury stock. Okay, so let's look at what a corporation is and how they're organized. Here, it's an entity created by law. I think of a corporation a little bit like a person. It's separate from its owners, and it has some rights and privileges. But it is possible for a corporation to be privately held as well as publicly held. Publicly held meaning that we sell its stock to the public. I, for example, have 400,000 shares of a privately held corporation called Vehicle Research Corporation in Pasadena. And the only way you can get stock from that company is to purchase it from me or one of the other stockholders. Okay, so we said that it's a separate legal entity here. It has limited liability, meaning that the corporation itself is liable, but the stockholders are only liable to the extent of their purchases of stock. That stock can plummet in value, and for that matter, go up in value, but that's the extent of the liability under most situations for stockholders. And we can transfer those ownership rights very easily by selling that stock to somebody else. It is continuous life. I worked, as some of you know, for Chrysler Corporation. Walter Chrysler died a long time ago, but Chrysler's still around. It has a continuous life. There's no mutual agency for stockholders, and the big advantage for a corporation is that it can sell its stock to the public, raise capital, and grow the corporation into a big corporation. The disadvantages are significant. Government regulations are particularly onerous for publicly traded companies. Not only do you have SEC reporting, but you also have now SOX reporting. Both of those take a tremendous amount of time and money to do. Corporations are taxed as a corporation. Corporations, like a person, has to pay its taxes, and they're not inconsiderable. Okay, so how are corporations organized and governed? Corporate governance is a system by which those companies are directed and controlled. The stockholders are the owners, and through vote, in proportion to the number of shares that the stockholders have, they elect the board of directors. The board of directors then appoints and hires the officers of the corporation, and then those officers hire employees of the corporation. So that's the governance structure. I might point out I was a chief financial officer, as some of you know, and as a chief financial officer, I'm down here on this chart. But my highest rank in a corporation, oddly enough, was that of a secretary, and that was my position on the board of directors as secretary. A fairly powerful position, I might add, but nevertheless, it's always a little humorous to me to relay that to students. Okay, the rights of the stockholders. They get to vote at the stockholders meeting, usually held every year, And sometimes they're just asked to submit a proxy vote, and you get a little thing in the mail that says, we recognize the following people as good choices for officers, et cetera, in the corporation, and we appreciate that you would vote for them, and you can send that little card back as your proxy vote for those people if you want, or you can vote for yourself. You can sell or dispose of stock, and your purchase is proportional to additional shares of stock. Okay, once you own stock, if the company elects to pay dividends, which is an option on the part of the company, you have a right to receive those dividends in proportion to the number of shares that you have. And if things go poorly and the company goes into liquidation or bankruptcy, and if there's any assets remaining after the creditors and preferred stockholders are paid, then you get a proportionate share of those assets. Okay, what does that stock certificate looks like? You can be a part owner of the Green Bay Packers here, as you see, and here's an example of that right here. Green Bay Packers, and it shows that each unit of ownership is called a share of stock, and a stock certificate is your proof that that stockholder has purchased those shares. And I think it's good to see an actual picture of what that certificate looks like. It looks very official here, doesn't it? Like green money. Okay, the basics of capital stock then. You want to know that authorized stock means very little. That's just the number of shares that the corporation's charter says you could sell if you wanted to. What you're more interested in is what has been issued. And then down here, it shows here's our authorized, and authorized and issued means that it's a piece of the total authorized, the issued shares. Normally, if you don't buy back any of your shares called treasury stock, if you don't buy that back, issued and outstanding shares are the same. The number of shares that are out in the public are the outstanding shares. But sometimes we buy back some of our shares, which we'll get into treasury stock here in the end of this chapter. You'll see that that does reduce your issued shares will be higher than your outstanding shares. The outstanding shares are what we use in almost all our metrics. So those are the number of shares that are out in the public, in the shareholders' hands, not in the treasury of the corporation. All right, we have no par value stock. Sometimes we have a par value. Back in the day, I mean a long day before my time, par value meant something. At least it was supposed to mean something. It said, we think every now and then a corporation goes bankrupt, and we want to reserve a little bit of that stock selling, that money, to pay off our unsecured creditors, normally our accounts payable people and our preferred stock people. And so we would issue, the par value would represent what we should have held on to for that purpose. But it didn't work very well. Companies that were going bankrupt spent every cent they could to try to keep from going bankrupt, and so the par value you'll still see on stocks dating way back in the day, and some people just like having a par value. It doesn't really mean much. No par value stock is certainly it's not assigned any amount per share as a par value, and sometimes we'll have a stated value, a no par stock that has an assigned stated value per share. Okay, so the stockholders' equity then on the balance sheet is going to have what's called paid in or contributed capital. And that's the total amount of cash and other assets potentially that the corporation receives from its stockholders in exchange for stock. I would tell you honestly, I've only sold stock and given up an asset for that once. So normally it's going to be cash that we use to that we get from the standpoint of selling stock. Retained earnings is the other piece of stockholders' equity, and that's the cumulative net income and loss, if it happens, not distributed as dividends to its stockholders. So that's from the inception of the company. Okay, so here par value is not related at all to the market price. The market price is what you would get if you sold your shares of stock today. That's the market price. And you can find that normally in the Wall Street Journal or the New York Times or something like that. Almost all the big newspapers publish a financial section that has that data. Par value is just an arbitrary amount, almost meaningless, honestly, assigned to each share of stock when it is authorized. Okay, so we have three classes of stock then: our par value stock, our no par value stock, and our stated value stock. So the stockholders' equity then is a combination of our common stock and retained earnings. And so the common stock general ledger account common stock is going to be based on par value. And then we'll have money that's paid in addition to that par, paid in capital in excess of par, as a separate general ledger account. And then retained earnings, you've seen that so far, and I think you know what that is by now. Okay, so let's look at how we do that real quickly. We'll record the issuance of corporate stock here. How do we do that? Here's old Dillon Snowboards, and they issue 30,000 shares at $10 par value for $300,000. So in this case, they got exactly 300,000, so they didn't have any paid in capital in excess of par. So all we do is we debit cash and credit common stock, $10 par value. And we multiply that out at what we received was 300,000. Very easy. Now, if we issue it at a premium, which we almost always do, we're going because par value is usually very small. Here, Dillon has issued 30,000 shares of that $10 par value, but they got $12 per share. So how do we record that? The cash that we have is 30,000 shares times $12. And the 30,000 shares times the $10 par value is the 300,000. So we received 60,000 paid in capital in excess of par, common stock. And that's how we would record that journal entry. And then if we issue par value stock, then this is how it's going to look on the balance sheet. We have our common stock, we have our paid in capital in excess of par, we have retained earnings. Now, that's going to show both our net incomes since inception, less any dividends that we paid. So in this is the company's first year of operations, and its net income was $65,000. So that means our retained earnings is going to be $65,000. So our total stockholders' equity section of the balance sheet is $425,000. That looks like a good place to stop our first video. And when we return, we'll take a look at issuing no par value stock. Until then, bye for now.